We are now on the second video in the series, the FICO series. My name is Raoul Cannon. I have 25 years in credit repair. I'm the author of $10 Credit Repair, the Ultra Edition. I'm a former bank underwriter. So now we got that out of the way. Let us talk about mortgages. Mortgages use FICO models 2, 4, and 5. These FICO models are older. And since they're older, let me tell you some things that don't help. When you use Experian Boost or you decide to use rent reporting, that doesn't help when you apply for a mortgage because those FICO models do not see that data. They do not use consumer reported data. Now, what does your mortgage lender look for? Your mortgage lender is looking for payment history and mix of credit. So they want you to have credit cards and installment accounts. They want you to have over 24 months of payment history with an installment account, and the same with credit cards. They really like for you to have 3 minimum credit cards, 2 minimum installment accounts, but remember, they're looking for good payment history. And that is going to lead us into how is your score seen? Now, when you are looking at your credit score, you pull it from TransUnion, Equifax, and Experian. And that is the same place your mortgage lender is going to get your credit reports from. But when you get your credit reports from them, you're going to see a 690. But your mortgage lender may see a 645. And you say, why is that different? What is such a big difference in credit score? Well, a 645 in the FICO 2, FICO 4, and FICO 5, the models that mortgage lenders use, they place additional weight on late payments, charge-offs, high utilization, and inquiries. That is correct. If you have a lot of hard inquiries, that will impact your credit score in those models. So that is why when you are looking to apply for a home, those items need to be your focus, and you need to pay attention to how many hard inquiries, do you have any collections, charge-offs, and high utilization. Now, if you have any of those, that is where your credit repair process is going to start. The easiest one to address is high utilization. If you've had a credit card for a long period of time, call that bank and request a credit limit increase. Once they give you an increase, that'll instantly drop your utilization. Now, if you can't get a credit line increase, you need to pay your credit card down. Credit cards, when you apply for a mortgage, they want utilization to be below 30%. So if your credit limit is $1,000, you have $300 on your credit card, that is 30%. And when I say below 30%, they want it at $200, around 20%, because they want to make sure when you get the home, you are not trapped and can't do anything else. They want to make sure you have room to breathe. Now, here are the items. If you have them on your credit report, you got to focus on them when you're applying for a mortgage or you're thinking about it. Any paid or unpaid collection, I said that correctly. Even if it is paid, you want to get it off your credit report. Late payments within the past 24 months, that needs to be a focus for your credit repair. High credit card utilization, I explained to you exactly how to get that down. Charge-offs, Inquiries. Now, inquiries are extremely important because it looks like you are not financially stable. So if you have a lot of inquiries, the mortgage underwriter, which I used to be, I'm going to be concerned, can you make your monthly payment? Thin files. If you've cleaned everything off your credit report or you don't have established credit, you will have an extremely hard time no matter how high your credit score is. This goes for those who, if you purchase trade lines, which I recommend don't do, or you have a lot of authorized users, you can have a high credit score on paper. But when you apply for a mortgage, they do not factor in your authorized user accounts. So you could have a 750 with 3 great authorized user accounts, and you may have 1 personal credit card of say $5,000 in the past few months. That is a thin file. When you apply for the mortgage, you're going to be denied because you don't have enough payment history. In that case, if you have a thin file, I recommend getting secured trade lines through Kickoff, Self, Magnus, and when you get it, as soon as it reports to all 3 credit bureaus, pay 90% of it down, and before you apply for your mortgage, pay it all the way down. And understand you need 2 or more, and make sure you get a secured trade line that will have 24 months of payments or greater, and pay it off before you go apply for your mortgage if you don't have established credit. Now, when you apply for your mortgage, understand your credit score is going to be either prime, which means you're going to get the lowest rates, or it's going to be non-prime, which is about a 620 to a 670 or 680. You're going to get higher rates, or subprime when it's below 600, typically below 580. So prime is here, non-prime is here, subprime is really at 580. Now, if you're at subprime, anytime you go from prime to non-prime to subprime, what does that impact? Not only your rate, but the amount of money you have to place down to purchase your home. So, of course, you want to be at prime because that lowers your down payment in a conventional loan. Now, I know there are many mortgage programs out there. I'm talking about conventional loans, but this also translates to those programs too, because they use the same FICO models, which are 2, 4, and 5. And what do they count harder? Collections, charge-off, and remember the collection, even if it's paid, it will count against you, so you need to get it removed, because mortgage companies are concerned about collections, because collection companies can place a lien on any real property, which would be your home, which means that would endanger their investment. That is why they look at collections extremely hard, and it can stop you from closing. So make sure you focus on those collections before you apply. Now, what do you do if you do have those on your credit report? You're going to use your dispute process and your credit repair to focus on 1, collections, 2, charge-offs, 3, hard inquiries, 4, utilization. Now, the dispute methods used come out of chapter 10 and 12. You're going to dispute a collection to prove chain of ownership. If it's being reported by a third party, you're going to use certified mail. You're going to use FCRA 611 dispute method, and you're going to use a furnisher challenge, which is 623. USC 623. You're also going to place a security freeze on all your secondary credit bureaus. You're going to remove all your old personal information, old addresses, old telephone numbers, old employers, and you're going to do that before you start your dispute process, because many times collections are tied to old addresses, and that is how they're verified if that old address is staying on your credit report. Now that comes out of chapter 7, 8, and 9, the dispute process. Now, make sure you tune in, because the next one I'm going to cover FICO Model 8 and bank cards, what they're looking for, what helps, and what you need to focus on if you're getting turned down or declined. Thank you. Look for you on the next video.